Hey everybody, and welcome to another awesome video with yours truly. I want to say hello to all my members. You guys are doubly awesome for being members of my channel, and it's so awesome to see you here today watching this. This is a part 2 of a video I did a few weeks ago that was basically about linking performance of a business to incentives. It's a little bit more of an advanced HR topic, and for those of you who are interested in this is something that executives have to deal with. It's sort of the number one thing when you're overseeing a lot of employees. It's the thing that basically ensures that your employees are pulling in the same direction that you are, that they care about the things that you do. And in its purest form, this is done at the highest level. This is what the CEO does, where they oversee the incentives of all their vice presidents and all their middle managers to make sure that these people have their interests at heart and that they care about the things that they should care about. Okay, so I've already done a video on this. I'm basically going to continue where I left off, and I have some notes here. I'll see if I can bring them up. Here we go. Okay, so as I said, linking performance and incentive pay. Now, I went over sort of the introduction to this in the first video. I'm just going to jump right in and continue on with some concepts. Now, in the first video, one of the things that I talked about was, what do we want to reward employees for? Okay, what's the ultimate metric that employees should care about and want to improve? And the big problem with setting different metrics is that there's always loopholes. You know, if we, for example, if we tie bonus pay to how much sales a salesperson makes, there are loopholes around that. They might start lying to customers to get a sale, but then the customers are upset discovering that what they bought was not what they were promised and all this kind of stuff. And if we were rewarding salespeople for that metric, then that has led to some behavior that for the organization we don't want. So how can we really get a metric together that will reward people correctly for the right behavior? And in part 1, we talked that what we said was the basic metric that we're wanting to reward employees for is the value of the business. So if the value of the business goes up, then employees should get the benefit of that. If the value of the business goes down, then employees should see some kind of penalty, because everybody that owns the company will see a penalty. The employees should feel that also. We need to have them pulling in the right direction. Okay, so we got as far as that on the first video. Let's go a step further now. In this video, I'm going to introduce 2 methods we can use to actually value the business, because this is the big question. It's all well and good saying that we need to do this, but how do we actually do it? Well, here we go. The first method for calculating, for placing a value on the business, okay, or on any business operation, is the discounted cash flow. For those of you who have a background in finance, you will know easily what this is. For those of you who don't, what this is it's a way of trying to predict the earnings, the profit that this business operation is going to make in the future. Okay, so if we can estimate what our profit is going to be, say, every quarter for the next 5 years, okay, what we could do is we can calculate, using the time value of money, what the equivalent value would be in cash right now. So if somebody's going to pay you $1 million in 10 years, you can figure out what's the equivalent cash value of that right now without having to wait 10 years. And usually it'll be considerably less than $1 million, okay? If someone's going to say, I can either give you $1 million now or I can give you $1 million in 10 years, everybody would say, well, I want $1 million right now because it's right now. It's worth more than $1 million in 10 years. Okay. If somebody said, well, I can either give you $500,000 now, or I could give you $1 million in 10 years, then it's not so clear. Then some people might be kind of on the fence, right? So that explains the concept. So if we figure out what our earnings are going to be into the future, and then we add them all up and bring them to value right now in cash, that's the value of your business. That's one way of coming up with a value for your business operation. Okay, so this is normally done by accountants or certified business evaluators. They can do this. Okay, now the discounted cash flow is what it's called. I'm going to refer to it as DCF. Okay, it's a term that they use in finance. The DCF model describes the general connection between business results and shareholder value. Okay, so what this is saying is that if you're trying to turn business results, like increasing your sales or increasing the reliability of a product or reducing your operational costs, okay, how does that translate into making the business worth more or less? Well, this is how it does it. It connects business results with shareholder value in this metric, okay? Now, management makes an investment of $100 in the business in forecast year one. Okay, so they invest $100 by buying equipment or something. If the plan were based mostly on operating income, this literally worthless decision would probably boost bonus payouts. Okay, so here's the problem. If we say, okay, we're investing money in the business, the problem is that we buy a bunch of equipment, but if it doesn't lead to the business being worth more, then that money that we spend buying new equipment is worth nothing, right? You see, the problem is that if we tied business goals to incentives, like you said, we invested in equipment, then the middle manager would buy a whole ton of equipment for their operation, and they would collect a big bonus payment for having bought all this equipment. That's not really what we want. That encourages the wrong behavior. Buying equipment is great, but it has to generate more than the equivalent value in profit, or else it's a misstep, right? So that's the value of this. Okay. Now, an executive or executives should create lots of intangible value. The problem is that if you send in the accountants to place value on your equipment, like your assets and your building and your property, plant, and equipment, and this kind of stuff, they can calculate the dollar value of all that stuff, but the problem is that alone doesn't lead to the business having value, okay, other than scrap value. That's the problem. We need to make decisions. We need to use these assets in important ways that will generate value. Okay, we'll maybe create a product that everybody wants, or we will maybe not use as much equipment, but instead we will turn on our brains and try and think of ways to cut costs, but maintain quality or even improve quality, things like this. Okay, and that's basically intangible value. So that's what we really want. Now, the typical approach is to base incentive payments on the valuation implications of financial performance. Okay, so this is the problem. If you make business decisions that lead to a financial impact, according to the discounted cash flow method, then that will affect the value of the business, and therefore that will affect incentive payments. So bonus pay and all kinds of pay that's tied to the performance incentive, in this case, which is the value of the business. Okay. Now, the other thing is that when you're talking about the value of the business, okay, depending on how you calculate how much a business is worth, a lot of times there'll be things out of your control, like the economy, there'll be the value of the currency, and there'll be economic conditions. Okay, so something that's brought up here is capital market conditions are not constant. Okay, so for example, if interest rates go up and things like this, that's going to affect the value of your business. If you are carrying a lot of debt, for example, and interest rate goes up and you have variable rate loans and all this kind of stuff, that's obviously going to affect the value of your business, but it's not through any kind of business decision. That's just through external conditions and externalities. Okay, so that's kind of a factor here. And we want to allow for this because we don't want to reward people for things that they haven't done, essentially, nor do we want to penalize them for things they haven't done. If the economy tanks, that's not necessarily something that we should penalize our employees and cut their bonuses for. If they've made bad business decisions that lead to profitability going down, when we cancel out economic conditions, then that's something that, we want them to feel the effects of. Okay. Incentives can include stock-based elements and goal-based arrangements. So you've got, in a lot of, the way this is usually done today in larger organizations, especially publicly traded companies, is that everything is based off the stock price. And that figures very highly in everybody's compensation. And this is kind of It's like a job interview. It's the best solution we have, but in absolute terms, it's a pretty poor solution. Because the thing is, in large organizations, individuals can't really affect the stock price that much. And a lot of other things affect the stock price too. Things we have no control over. All of a sudden, the obvious thing is you have, economic cycles and things like this. I mean, stocks go up, stocks go down. It has nothing to do with the performance of the company. It has to do with the larger economy. So, that's the big problem with this, right? It's good in that it makes the managers of the company feel the same conditions as the shareholders, but in terms of trying to get their incentives to align with what we want them to do, it's not really that effective. Okay, so goal-based arrangements are a lot better in this regard than simply basing everything off stock prices. Okay, but they have their issues too, and we're going to get into that. Okay, what companies pay for much more consistently is not value creation, but investor return. Okay, so this is the other thing. Now, it's great to have a very valuable company, but at the same time, that really isn't what investors care about in absolute terms. They want to see a return. And the obvious big example of this was Amazon. Amazon was a very, very profitable company for many, many years. But Jeff Bezos was famous for reinvesting all the gains back into the company. So they weren't paying dividends, and they weren't, really channeling any of that gain to the shareholders. It kept being reinvested and reinvested and reinvested. And the shareholders were famously annoyed at this because, this company had been an amazing success, but they weren't really seeing a payoff. So when it comes down to it, investor return is the thing that investors care about. Okay, so what's the lesson here? It's basically to take success one step at a time with goal-based incentive plans. Okay, so this is the way that I have done, the method I have followed in the past, and that I would recommend people do. This has worked in small to mid-sized organizations. I haven't had the opportunity to implement this in larger organizations. I've advised people about it, but I haven't been able to really practice that. So I'm confining my recommendations here to smaller or mid-sized organizations. So that's where this kind of leads us. If we're basing everything on a valuation using discounted cash flow, that's kind of the implications of it. Okay. Now, there's a little bit more here. Okay. The second of two methods that I wanted to get into in this particular video was the second valuation model, which is the market comparison approach. Okay. So this is basically where you're looking at the market. Okay. It is paired with the discounted cash flow as the two most typical methods. Okay. So going off discounted cash flow and going off, market comparison, those are the two most common methods of valuation for a business. Okay, it relies on multiples of earnings, volume, or capital. So this is where a lot of people kind of throw this around when they value startups and things. They basically look at similar companies, and they look at the market price for what people will pay for it, and then they do a multiple. And the problem is that this is based on the market, which is basically based on what people think of this organization. And that can be good, but it could also be bad because maybe people, don't have all the information, and maybe they're biased against certain things or for certain things. So, it's an alternate way of looking at it. Okay. Now, incentive plans should reward management only for economically meaningful results over time, not for choices about their accounting portrayal in the short run. Now, this is the other thing, okay? The problem is when you're placing value on a business and you're doing valuation, the problem is when you go off a market-based valuation model, there's a lot of guesswork. There's a lot of assigning things value that you're assuming that the market would pay, okay? And sometimes these are accurate, especially when you have a lot of data. We can make very accurate estimations of this, but sometimes when there isn't a lot of data, it's a complete guess and it could be completely out to lunch. And this is the problem with this. This can work in our favor or it could work against it. Okay. Some of the biggest scandals in the United States in some of the, big companies like Enron and WorldCom and stuff like this, it was to do with market pricing of things, where we're sort of assigning things to market using mark-to-market accounting and this kind of stuff. And basically, you're looking at the company like it's like a stock price, okay? And that's it. This can create some problems, but it solves some problems in some certain situations. Like, for example, in a lot of startups, I mean, if the company has not been revenue positive, if they haven't received any earnings yet, but they've invested a lot of money into something that is expected to pay off, maybe they've developed a product and they just have to take it to market, that's a situation where this is a much more accurate way of doing valuation for that business. Okay, now regarding changes in invested capital, okay, so this is more of a finance thing, but one important metric is free cash flow, okay, should be the main incentive factor, okay, so this makes the organization's capital structure irrelevant. If you don't know what capital structure is, that's also a concept from finance. That's basically where you look at all the stuff you have, okay, all your assets, all the things you control, your building, your plant, your intellectual property, everything that you have control over, and you assign it, either it's paid for outright or it's essentially you've borrowed money to pay for it. So it's not really yours, okay? If you own, say, 10 million worth of stuff, whether that's prepaid rent or you've bought equipment or you've bought a fleet of vehicles or whatever, you have 10 million total value or total assets. How do you assign ownership of that? Do you own it outright, or have you taken out a loan from the bank for $10 million and just used that money that was lent to you to pay for all this stuff? In which case, it's entirely financed with debt, right? So capital structure is basically what percentage of that is owned outright and what percentage of that is sort of been bought with debt. Okay, so you could have 50-50, you could have like 90-10 or 10-90, right? Okay, so the problem is a lot of organizations is they will borrow money, right? They will buy more stuff, but it's not because they're making more money, it's just because they're borrowing more money. And thus they're changing their capital structure. They're financing more of their stuff with debt, okay? So where was I here? So free cash flow is a metric that sort of ignores capital structure. It looks at the amount of money coming in the door, the amount of money that's coming through your checking account, like the company's essentially their checking account, and goes off of that rather than looking at their capital structure. Okay. However, financial executives and CEOs ought to be encouraged to use capital structure to create value for shareholders to the extent they can. Now, in practice, in smaller organizations, I'm not really a fan of this, okay? But in larger organizations, if you're, say, the CFO, one of the big things you're going to be concerned with is with the capital structure. And you're going to be trying to figure out what is the optimal capital structure for you that balances your risk of defaulting on loans and your ability to use debt to amplify the shareholders' money to make profit, okay? So there's a whole bunch of complicated financial stuff in there, but the bottom line is that for smaller organizations, I don't consider this really a value-generating operation. CFOs, as far as I'm concerned, as long as they're good accountants and as long as they're good treasurers, they can raise money on demand, and you have good relationships with lenders and things like that. That's really all I care about. It doesn't really play into value, placing value on the business, doing evaluation. And finally, the last point here is regarding the time frame of incentives, okay? Because the time frame is very important. If you pay somebody, if they made money this quarter, like right now, they get a big bonus, they'll engage, as you can imagine, in all kinds of short-term gain activities. The biggest one being, you can sell the business. The CEO can sell the business. I mean, if you want to make a lot of profit right now and you don't care about the future, that's the number one thing you can do. You can turn around, you can instantly make an incredible amount of profit by selling the company. The only problem is that obviously once that's happened, your profit will be zero. The time frame of incentives matters. Okay, what you want is a very long time frame. But the problem is there's a lot of problems with that too. Okay, so value is a function of expected performance over the long run. Okay, so when we talk about valuation of the business, we're looking at over the long run. Okay, incentive plans tend to last 3 to 5 years. Okay, in terms of when you study compensation, the term long term means anything over a year. Okay, usually everything we talk about in compensation is an annual basis or less, right? Like people get an annual salary or an annual bonus, right? So anything over 1 year is referred to as long term. In this case, when it comes to business strategy and looking at business decisions, they're looking 3 to 5 years out. Okay. The question is not, does it pay off now? The question is, how has it paid off over 3 to 5 years? Okay. The next few years are the most critical, since this period allows management to prove or disprove the viability of current strategies, skills, and actions. Okay. So yeah, like that's how you know if your business decisions now were good. Did they make money over the long term? And in order to know this, you have to wait till you see the long term before you can reward people. Okay? Otherwise, you're rewarding them for short-term gain, and that really isn't the best long-term strategy. Okay? If you're in larger organizations, if you're in publicly traded companies, everything's based off stock prices, and they grant stock options, which is the main way they pay executives. Okay, options are exercised on average around 5 years after they're given, okay, after they're granted. So, that's how they do it in those organizations, but it's still based off stock price, so that has a whole series of problems like we've already discussed, okay? But if the economy booms or the economy tanks, and it's not really necessarily your doing if the stock price went up or it went down, that's the most obvious problem right there. So there you go. So that's kind of what I want to cover. That's probably good for this video. But yeah, so this is these are some principles to think about when you're designing the incentive structure for your executive management or even your middle management. How are you going to reward them? What are you going to be looking at? The tendency for some people is to try and create these extremely complex arrangements where they're looking at multiple metrics, and they've got these very complicated formulas, and that in theory, it seems like that's what you would want to do, but in practice, it doesn't work so well, because the more of those little metrics that you're looking at, the more opportunities there are for loopholes, for the executive to find a way of getting that metric to go up, but not really doing what they should be doing, not doing things properly. Like our example with the salesperson, right? A famous example is, if you work in the quality department and you have metrics for the quality of a product, and the management is rewarded on the quality standards of their product, right? Well, there's been a lot of cases where management will decide that, that quality standard is not optimal, and we'll need to change the quality standard. So magically now our product gets a perfect score. There we go. And consequently, the management gets a bonus for hitting quality goals when all they've really done is they've changed the quality criteria. And so, that's a total loophole, right? If they get to decide what the quality standards are, this is a problem. So the more of those little finicky, complicated arrangements we make, the more opportunities there are for loopholes. So this is why when we do this at high levels, organizations tend to use the single metric of the valuation of the business. The question of how they arrive at that is a bit more complicated, but they use that as their top metric, and then they reward everybody over the long term based on if the value of the business goes up or it goes down. And there you go. So that's probably good for this episode. Thank you so much for listening. If you were watching to the end of this video, I salute you, because this is more advanced topics, and I don't really see many people talking about this stuff. So hopefully it was somewhat interesting. Anyway, thank you very much for your attention. Thank you once again for being my members. You guys are awesome. And I'll see you in the next video. Take care.